Let's talk about Exxon Mobil. Let's talk about all the gas. Let's talk about the exaggeration of the death of big oil. Let's talk about cash. Exxon Mobil Corporation closed today 113.95. That's $113.95 per share, down 0.5%. I wanted to go over my trade numbers for ExxonMobil because on September 1st of this year, my 500 shares of ExxonMobil, they were called away. They were assigned, they were taken from me, stripped from my ownership. But I volunteered for that sale, and I wanted to go over the numbers just to show you how much fun I had in that trade, which began on May 1st of this year. So essentially 4 full months I was in the trade. Got in, got out, collected some premium, some dividends. But ExxonMobil, one of those oil sweethearts, you know how I like them, but I was looking through seekingalpha.com, and one of the first articles on here, ExxonMobil, a strong sell ahead of the last age of oil. And I chuckled to myself and I looked. And if you look at these, here's one, ExxonMobil, renewables do not spell its end. It has 23 comments. Below it is ExxonMobil, a good time to buy now. Technical analysis, 18 comments. And then you see here, and this is the sensitivity of such a headline and such a position. This Seeking Alpha author called ExxonMobil a strong sell because it is the last age of oil. But look at these comments, 1,164 comments. And I'm with most of the commentary on here, which says, whoa, whoa, whoa. Wait un momento, por favor. Mobil oil, ExxonMobil, oil in general, it's going nowhere, is it? It is going nowhere. Its demise has been greatly exaggerated. So let's look at some of the information that reminds me of this fact. If we go to alphaspread.com, one of the websites that I enjoy visiting, researching, looking at, they'll say, hey, ExxonMobil, it's overrated, currently overvalued at 9% of its intrinsic value. So its actual value, 103.73. And this is the reason that I let ExxonMobil go at $111 per share. We'll get to that spreadsheet in a moment. But it is currently trading at, if you look down here, currently trading at $114.11. So I let it go just a little bit early. I still made some dollar bills. But the reason I like big oil is big money. It's big money. I like to make money here at the Wealth Snowball. My name is Bart. I am your best friend in stocks, options, and dividends. I like all of those things. But look at this, $364 billion in revenue. $51.7 billion in net income, $46.3 billion in free cash flow. Cash flow after expenses, free cash flow, the money that they're able to then build their business, grow their business, and pay me, sweetheart me, dividends. Okay, so if we go to dividends on Exxon and the Mobil, you see that currently they have had 24 consecutive years of dividend growth. Hello. Currently paying out $3.64 per share per year, 91 cents per quarter. Now, if we look at the dividend history, we can see the growth in the quarterly payments over the years. So, for instance, here we are, 20 and the 23. So the ex-dividend date just happened a couple of weeks ago on August 15th. And that payment will be made on September 11th. So that payment is coming up, and that payment will be 91 cents. Now, here's what I know in my little noggin is that likely, based on the trend, we're going to have a increase in the quarterly dividend payment on the next dividend, so Q4. And the reason I say that is if you look at, they went from 87 cents per quarter to 88 cents per quarter. Okay, 1, 2, 3, 4 quarters. Now they have paid, or they will be paying, their fourth consecutive quarter of 91 cents per. So that next quarter should be a raise. So if you're an owner of this company, if you're an owner of shares in this company, you're going to receive more than 91 cents per share per quarter going forward starting next quarter. So currently I own no shares, 0.0 shares of ExxonMobil because my 500 shares were called away in a stock option, a covered call, if you will. So if you own shares of a company and you would like to increase your own income, your own cash flow in that company, and I love to do it in a number of different companies, one of which would be dividend paying companies. And a dividend essentially is a share of the profit. So when I look at all of the cash, all of the dollar bills being collected by a company such as ExxonMobil, $51 billion in net income, $46 billion in free cash flow, they do a couple of things. They buy shares back, which then lessens the number of shares outstanding, okay, which essentially and directly makes my shares more valuable. And they pay dividends to people like me based on the number of shares that I own. So in selling options, I like to collect the dividend and collect the premium, which is the cash flow in selling those options. And when you think about oil and its, its imminent death with all this renewable energy, just look at what oil has done just recently. Hello! Right on up to the top of the mountain here is the price of oil per barrel, crude oil. This is crude oil futures, but this is through today. Actually, that's through yesterday. Today is Thursday, September 7th, and this is through Wednesday, September 6th. So oil prices continue to skyrocket, which means in the next quarter, profitability of all of these oil companies is likely to go up as well. So let's look at the trades that we've made. Let's go to the individuals. Okay, so this is Exxon and the Mobil. Let's move my big head over here, just real quick like. I entered my first trade on ExxonMobil this year on May. It actually wasn't my first trade, but this trade is what locked in my ownership. I started with a put spread. Okay, so I sold a put spread, which means that I sold the obligation. Okay, it was my obligation to buy shares of ExxonMobil at $112. Okay, then the spread, which limits your downside risk, which means I then bought the $109 strike price, and a strike price is the share price of this company, ExxonMobil, in what is considered a derivative. So I didn't own any of the shares at this point in ExxonMobil on May 1st, but I sold a put credit spread, which is I had a 112 short leg, which is my obligation to buy. And then I bought a 109 long leg, which was my right to sell at a $109 strike, 5 contracts, and I collected $255 for doing so. That is money that goes into my pocket, and nobody can take it away. On May 4th, I split that credit spread up. Okay, so I split it up, which is I sold to close. That's the STC. I sold to close the 109 long leg, which is what I had bought in the put credit spread. I sold the right on those 5 contracts and collected $1,550 bills. And the reason is that when I put this trade on May 1st, I believe ExxonMobil was at $114 a share. By the time I sold this to close, ExxonMobil was going downtown to Chinatown and was down to like 107, maybe $106 per share. So that's why I was able to collect such a large premium for selling that long, those 109 strike long contracts, 5 of them, $1,550 collected. On the next day, Cinco de Mayo, I rolled, excuse me one second, I rolled the remaining $112 strike, which was the short leg. I rolled it to 111. So, for instance, picture that stock price going down. In fact, let's look at it. Let's look at that stock price. Let's go to bar chart. Kind of like the looks of bar chart. Let's go to bar chart, bring up ExxonMobil, and just go back to those dates of early May to see exactly what that stock was doing. Okay, so if we go out, we're going to have to go out 6 months just to collect that data. Looking at the dates, okay, if we go back to the beginning of May, if you see the date down here at the bottom, right here, okay. So May 1st, if you look, was the first drop. So on April 28th, which would have been a Friday, we had ExxonMobil all the way up to like $118 a share. On the following Monday, it began to drop, and I'm like, hey, it's not going to drop that much. So I'll go ahead and sell or create that put credit spread and collect the dollar bills. So that's why I put the $112 short leg, which is my obligation to buy those shares on or before the expiration date for $112. Well, in the meantime, woo, Geronimo, you see these are called candles. Red means down, price is going down. Green means up, it's going up. So it was going downtown to Chinatown. If you look at the date at the bottom, that date is changing. Okay, so on this date here, when the stock went all the way down to just about $106 flat, I was able to sell that 109 long leg for such a huge credit, $1,550. In the meantime, the following day, Cinco de Mayo, May 5th, the stock begins to go up. So I was able to sell, even though I paid I was about to pay $112. That's the wrong spreadsheet again. I had the 112 in place, right? I was obligated to buy 112 shares or $112 per share. I rolled it down to 111, okay, which was still way more than what the shares were going for when the market closed on May 5th. So I paid $111, but the market had it at 106 and change, right? Go back to the bar chart. So on May 5th, you have the stock trading at maybe 108.59, and I paid more than that. I paid $111 per share, but I was also paid to roll that. So I rolled that out, collected $195. On May 17th, those shares were assigned to me, which is the other end of that contract. The owner of those contracts can put those shares to me. They can assign those shares to me and make me pay 500 or make me buy 500 shares at $111. So on May 17th, I did indeed cough up $55,500, but now I own the 500 shares, but I still have all of this premium that I've collected along the way. On that same day, I'm like, hey, even though this ExxonMobil's down and I just paid $111, I will sell the obligation of those shares. I would be obligated to sell them at $106 per share, even though I just paid $111. So that is a risk that I took. 5 contracts, collected $85. I then rolled it again. So this roll C, that means roll call. So before this contract expired, I rolled it 2 days later and I rolled it out another dollar. Okay. So I'm protecting myself another dollar. So here $106, I'd be losing $5 a share because I paid $111. I rolled it out, added another dollar, so now I'm $4 per share in the negative, but I collected $175 in doing so before they were called away, before somebody bought them for $107. I rolled it again. May 23rd, rolled it out to $108. So we're getting better. We're getting closer to our basis that we paid at $111. I collected $35 more dollars. June 1st, collected another $255. June 7th, rolled it again and rolled it to $109, collected $160. June 21st, so we let those expire. And then on June 21st, we started another covered call sell at 110. So now we're even another dollar higher, 5 contracts, $100 collected. July 3rd, rolled it at 110 for 95. At July 11th, we rolled it up to our break even as far as the share prices are concerned at $111, collected $84 for doing so. Rolled it again on July 21st for $76. Rolled it on August 8th for $145. Rolled it on August 18th for $460. Hello. Rolled it again on August 25th, $111 per share, $140. And then on September 1st, those shares were assigned, meaning someone bought them from me for $111 is what we paid for them. So we made $0 on share appreciation because we paid $55,500 for them and then sold them for $55,500. So why would you even do that? Well, we did it for the premium and the dividend. So if you add all of the premium we collected, plus the $455 dividend that I was paid because I was an owner through the ex-dividend date, which is the day you lock in your dividend payment for being an owner. You could sell it the next day, but I locked in my $455. So I collected $4,265 in 122 days. That's how long the trade took place. So what I wanted to do with you is let's do a quick calculation here on my digital abacus. What did we make if this was an annualized return? So if I was able to make this type of trade over and over again throughout an entire year, so instead of 122 days, it was 365 days, what would be that annualized percentage of return? So to figure that, what we do is we take what we made, which was $4,265 of actual cash in our pocket. We divide it by our initial investment of $55,500, okay? Then we divide it by the number of days that we are in the trade, 122 days, and then we multiply it by the annualized 365 because that's how many days are in a year, and that gives us 22.9% annualized return. Hello. So let's put that on the board. 22.9% annualized. So how often would you accept 22.9% annualized, Bart? Every day of the week, and drum roll please, twice on Sunday. So that's what we have going for us on this Exxon Mobil trade. Let's put a little color to this. Let's make it green because that's what we like to see when we're making these trades. We like dollar bills, and dollar bills are green. So we made $4,265 in 122 days on this particular trade. So that is Exxon Mobil. Currently, I do not own it. However, once it gets back under $110, I'll be looking to sell puts again, and we'll start this all over again. That is the idea. I wanted to share that with you because recently these shares were sold off through a call assignment. No longer owner, but still a happy participant in the profit that was created in doing so. So thanks for joining me this individual trade. These are individual positions, and we've had many, and I'll be sharing more as we go in and out of these in what we call the wheel of fortune, because we keep selling puts, collecting premium. We keep selling calls, collecting premium. We keep collecting dividends, and that is the wheel. When the puts are assigned, we sell calls. When the calls are assigned, we spin the wheel again, get back into the puts, followed by assignment, sell the calls. Shares are called away. We run the numbers. We say, okay, 22.9%. Are we happy? We are. And that is my goal as I look for 20+% return on wheel trades. And this one worked out brilliantly. And believe me when I tell you, the demise of oil, big oil, is greatly exaggerated. So until next time, make sure you are indeed a subscriber to the channel, like the video, leave a lovable comment, share it with one of your good friends, and I will see you in the next video.